Multi-choice slashes DSTV decoder prices, offer subscription upgrade amid declining customers, pay TV operators. Welcome to Business Point, where we extract the Nigerian economy and the government policies. I am Kike Lomo Okeri. Multi-Choice Nigeria has slashed its decoder price by 50% from 20,000 naira to 10,000 naira in a strategic move to woo more customers and stem the tide of declining subscriber. The Pay Multi-Choice says it has slashed its decoder price by 50% in order to woo more customers and stem the tide of declining subscriber. The company says it will also be offering its customers a free upgrade to the next DSTV package tiers, where they pay their current subscription in full from June 16 to July 31, 2025. This is coming after losing 1.4 million subscribers between March 2023 and March 2025, I beg your pardon. Multi-Choice claimed that the initiative is a response to the noticeable economic impact on the everyday lives of Nigerians, according to an official statement from the company. The upgrade is automatic for all active and returning subscribers who renew their subscription during the promo period. Multi-Choice Nigerian CEO John Ugbe noted that the offer was the company's way of rewarding customers' loyalty and providing enhanced value. It could be recalled that Multi-Choice Nigeria had increased its DSTV and GoTV subscription price 3 times within the 2 years. The group blamed the several factors, including high inflation, power grid collapse, and fuel scarcity for the subscriber to lose in the country. It further reveals that Nigeria accounted for 77% of the subscriber loss recorded across its rest of Africa operation between 2023 and 2025. According to the figure released by the group, the rest of Africa lost a total of 1.8 million subscribers in 2 years, bringing the total subscriber down to 7.5 million in 2025 from 9.3 million recorded in 2023. Pensioners under the Nigerian Contributory Pension Scheme have appealed to the National Assembly to approve the full implementation of the 758 billion naira treasury bond announced earlier this year, intended to clear decades-long arrears owed by the retirees. The bond, approved in February 2025 by President Bola Ahmed Tinubu during the Federal Executive Council meeting, was introduced to settle outstanding liabilities under the CPS for the federal retirees. The initiative aimed to resolve long-standing pension obligations, some of which date back over 16 years. The national chairman of the Nigerian Union of Pensioners Contributory Pension Scheme sector, Sylvia Nwawu, called on lawmakers to prioritize implementation without delay. Nwawu expressed concern that many retirees had passed away after celebrating the bond approval, yet never received payment due to implementation's delay. He warns that continued inaction risks further casualty among aging pensioners, citing stressing-related health issues. He added that if the implementation proceeds successfully, the union plans to hold a nationwide event to recognize and celebrate the president's action. It could be recalled that in February, Omolola Oloworaron, the Director General of Pension Commission, provided further clarity on the bond breakdown. She says 253 billion naira had been earmarked for settling accrued pension rights of retirees, federal workers from Treasury Fund ministries, departments and agencies, aiming to eliminate delays from past funding gap. 388 billion naira was allocated to cover unpaid pension increase since 2007, which had been outstanding for nearly 2 decades. For the first time, the government committed 107 billion naira to pension protected fund to support vulnerables, low-income pension in achieving a more stable retirement home, and additionally 11 billion naira was designated to close the pension shortfall for the university professors. This funding enabled full implementation of the policy allowing qualified professor to retire on full salary, a provision hindered in the past by budgetary constraint. Oloraro also noted that going forward, all accrued pension rights will be incorporated into the federal payroll process via monthly personal cost general warrant, ensuring money timely and automatic disbursement. The Bureau de Change operators have insisted that there's an extreme large amount of foreign exchange liquidity in the system that is unaccounted for. They have ever called for a cohesive strategy between the Central Bank of Nigeria and the BDC operators to tap into the opportunity. The licensed currency trader said that part from collaborating with the Apex Bank of Nigeria, they are always ready to share skills and techniques to make the retail forex market better. The BDC operators had always advocate for increased participation and involvement in the foreign exchange market to ensure the success of the various policies being implemented by the Central Bank of Nigeria and help provide more liquidity. The push by the BDC followed the June 2023 unification of all segments of Nigerian foreign exchange market, consolidating all windows into one. This action by the Apex Bank was part of a series of immediate changes aimed at improving liquidity and ability in the Nigerian foreign exchange market. The currency trader had advised the CBN to always leverage the BDC and allow them access to banks, autonomous window, and agencies of international money transfer operators. Top BDC operator had accused some of the international money transfer organization of diverting diaspora remittance outside the system, with even the commercial banks complaining of not seeing this remittance. Despite the foreign exchange policies introduced by the CBN to help improve liquidity, transparency and efficiency in the forex market, the supply from the various channels is still a challenge. This is further compounded by the uncertainty surrounding the inability of most of the BDC operators to meet the CBN recapitalization deadline, with the naira hovering around 1,600 naira to $1 per day. Let's take a quick short break. We'll be right back. Don't go away. Stay with us. Welcome back. If you're just joining us, it's Business Point, where we extract the Nigerian economy and the government policies. Corn oil in the first quarter of 2025 pre-tax profit collapsed by 93% to 372 million naira, its lowest quarterly performance since 2021. The primary culprit appears to be the 48% jump in short-term borrowing funded through bank overdraft at an average interest of 29.75%, nearly doubling the company's finance cost within 3 months. For a company that ended 2024 with 323 billion naira in revenue and a strong earning rebound, the sudden turn is about shape and unsettling. Revenue declined 13% year-on-year to 79.3 billion naira in the first quarter of 2023. A significant pullback for a company that has closed 2024 on a high sales remained concentrated in its core white product business, accounting for 96% of the total revenue, while lubricants made up the remaining 4%. All sales were generated locally, highlighting the company's exposure to domestic market volatility. The cost of sales dropped by 9%, but that was not enough to shield margin. Gross profit fell 43% to 5.3 billion naira, pulling gross margin down from 10.2% to 6.7%. Overhead expenses remained relatively flat at 2.6 billion naira, yet now consume almost 50% of the gross profit, a significant shift from just a year ago. But the main pressure point was not just margin erosion, it was finance cost. Corn oil interest expense soared to 2.29 billion naira, up from 983 million year ago, primarily because corn oil borrowed more and faster in just 3 months. Bank overdraft rose by 48% to 42.4 billion naira, now exceeding the company's shareholders' equity of 39.78 billion naira. This means the corn oil now running with more debt than owners' capital, an uncomfortable position for any company. According to the note to the account, the company offers a single paragraph of explanation saying bank overdrafts are repayable on demand. Average interest rate approximates 29.75% based on the Nibo Plus ledger markup. There is no security or pledge on the company's assets with respect to the borrowing. The company's liquidity profile offers some clues. Current assets make up 96% of total assets, but 63% of that is tied up in trade and other receivable. Inventories rose by 10.4 billion naira, receivable by 11.47 billion naira, which suggests more goods were pushed out on credit, but the cash hasn't come back. Meanwhile, payable increased by 7.85 billion naira net to net. It still meant over 14 billion naira in working capital was absorbed into the operating cycle in the first quarter alone. This signals a classic strain in the working capital loop. Corn oil is still stocking more, selling more on credit, and stretching its own payable, but not nearly enough to offset the build up on the asset side. This model, buying fuel, selling on credit, plugging cash gap with expensive overdraft, may have worked then when margins were wider and borrowing was smaller, but at current volume, rate and cost of the capital, it's a tightrope act with little safety net. Overall, this is not yet a crisis. The company still has a strong market presence and scale, but without better control over cash, credit, and capital, it risks drifting from short-term strain into long susceptibility. Total Energies Marketing Nigerian PLC has projected a profit after tax of 543 million for the third quarter ending September 30th, 2025, despite significant finance costs impacting overall profitability. The company expects revenue of 177.1 billion naira for the period, with a cost of sales estimated at 150.6 billion naira, resulting in a gross profit of 26.5 billion naira. Operating profit is forecast at 7.7 billion naira after accounting for selling and distribution cost of 3.6 billion naira and administrative expenses of 17.1 billion naira. However, finance costs are expected to weigh heavily on bottom line, with the interest expenses forecast at 7.2 billion naira, which surpasses the project finance income of 933 million naira. This results in a net finance cost 6.3 billion naira. Before tax, Energies anticipates a profit of 1.4 billion naira with an income tax expense of 886 million naira. On the cash flow front, the company projects net cash generated from operating activities of 19.1 billion naira, supported by cash received from customers totaling 159.4 billion naira and cash payment to suppliers and employees of 135.5 billion naira. Investing activities are expected to result in a net cash outflow of 1.6 billion naira. Total primarily due to the purchase of fixed assets and proceeds from the sales of property, plant and equipment. Financing activities forecast a net cash flow of 27.1 billion naira, largely driven by interest paid on overdraft amounting to 7.2 billion naira, repayment of borrowing totaling 17.3 billion naira, and dividend payment of 2.6 billion naira. As a result, Total Energy expects a net decrease in cash and cash equivalent of 9.7 billion naira during the quarter, bringing the project cash and cash equivalent balance to a negative 155.5 billion naira by the end of September 2025. Foreign portfolio investors in Nigeria equity market traded 996.03 billion naira worth of stock in 5 months to May 2025, as against 458.29 billion naira seen in the corresponding period of 2024. This means that their deals doubled in 2025 as they leverage forex and general economic stability. The record value of equity transaction by the foreign investors in 5 months this year represents 29.17% of the total value of stock traded in the Nigerian Exchange Limited. All right, let's take a quick short break. We'll be right back. Don't go away. Stay with us. Julius Berger Nigeria PLC has announced a total gross dividend payout of 5.2 billion naira at its 55th annual general meeting, which was held recently. In a statement by the company's senior media relation officer, Emmanuel Isibo, the chairman of the Julius Berger Nigerian PLC, Goni Sheikh, announced a total gross dividend payout of 5.2 billion naira to shareholders, amounting to 3.25 per 50 kobo ordinary share. Sheikh says Julius Berger Group financial results continue to be heavily affected by persistent inflation, currency devaluation, and high lending rates, which led to rising construction costs coupled with security challenges and unrest in the certain parts of the country. The company will continue to mitigate risk and ensure steady operations. In his address, the managing director, Dr. Pierre Lubachi, noted that since he assumed office months ago, the company has successfully navigated headwinds of challenges in its line of duty. Lubachi says the broader socio-economic environment continues to present significant challenges shaped by a range of persistent and compounding pressure like currency devaluation, ongoing foreign exchange scarcity, escalating construction costs, surging inflation, increased fuel prices, high lending rates, global market uncertainties, and domestic security concern. These foregoing factors combine to create a tough and unpredictable business landscape, especially for the construction sector and Nigeria in particular. He added that, in line with the company's mission statement, it will continue to transform these challenges into tangible opportunities. Lubachi says the company has achieved a record high revenue, expanded its asset base, and maintained stability across both new and ongoing projects within the new reporting year. Lubachi added that the company has taken significant steps forward with regional diversification strategies with 2 contracts in the Republic of Benin. Even he assured excited shareholders of greater success in these hard times, which he attributed to the well-disciplined execution strategy, agile leadership, the dedication of the team, and the power of fundamental value of excellence, responsibility, courage, and collaboration. This is where we draw the curtain on Business Point today. Join me again tomorrow for another edition on Global Television, on DSTV channel 365 and on Start Time 276. To stay connected, kindly follow us on all our social media handles and our website globaltvabuja.com. You can also download the Global TV app on your Android phone. Till I come your way again, I am Kike Lomo Okere. Thanks for watching.